Hello friends, if you receive the state pension or you are getting close to state pension age, this affects your money directly. So stay with me here. Right now, two things are happening at the same time that most pensioners do not realize are connected. Your state pension just went up under the triple lock, and that is genuinely good news. But that increase has pushed a lot of people within a hair's breadth of a tax threshold that most assumed they would never reach. And separately, if you have never checked whether you actually qualify for pension credit, or you checked a while ago and were told, no, the threshold is moved. And you may be one of the people walking past money that is sitting there unclaimed right now. Here is exactly who this affects. Anyone receiving the state pension. Anyone with even a small amount of income on top of it, a workplace pension, savings, interest, a part-time job. And anyone who has not checked their own numbers in the last year, because more of these thresholds moved in April than most people realize. Quick note, everything here comes straight from the official UK government website, HMRC, and the Department for Work and Pensions named as we go, and it's educational, not personal advice. So check your own record for your specific numbers. Now, let's get into what actually matters in order of how much it could cost you if you miss it. Three things. Quick question before we start. Do you actually know right now whether you are on the new state pension system or the old basic state pension system? Drop it in the comments because the answer changes which numbers actually apply to you. And that confusion alone is the reason a lot of people end up thinking something has gone wrong when it has not. Number one, and this is where most of the confusion in comment sections under videos like this one actually comes from. The full new state pension for 2026-2027 is £241.30 a week. But that is the maximum, and it only applies to people who reached state pension age on or after April the 6th. 2016 with 35 or more qualifying years on their national insurance record. The full basic state pension, the older system for people who reached state pension age before that date, is £184.90 a week. Here is the part that genuinely confuses people, and rightly so, because it is not obvious at all. If you are on the older basic state pension system, you may also have built up something called additional state pension, sometimes referred to as SERPs on top of that basic amount, based on your earnings and national insurance contributions during your working life. That is exactly why two people can have worked the same number of years and still receive completely different totals. They might be on entirely different systems depending on when they reach state pension age. Or one of them might have years of additional state pension layered on top of the basic amount that the other does not have. There is also a separate group worth mentioning here. People whose employer opted them out of part of their state pension contributions through a workplace scheme, often called contracting out in exchange for a different pension arrangement through their job. If that applies to you, your state pension amount can be permanently affected even though your own national insurance record looks complete. And that is a genuinely separate situation from simply having fewer qualifying years. If the number landing in your account does not match either of the maximum figures you have seen quoted online, that is very likely why. And it does not necessarily mean anything has gone wrong. The only way to know for certain whether your own amount is correct is to check your own state pension forecast and your national insurance record directly on the official gov.uk website. It will show you exactly how many qualifying years you have, what your expected amount is, and whether there are any gaps that could still be filled through voluntary contributions. And if you find a gap you believe is wrong, the Future Pension Center can talk you through whether filling it would actually be worth the cost. Number two, and here is where the triple lock increase and the tax system collide in a way that is catching a real number of people off guard this year. The full new state pension for this year comes to £12,547.60 over the full year. The personal allowance, the amount of income you can receive before paying any income tax at all, has been frozen at £12,570 for several years now. The gap between those two figures is just £22.40 a year. If your only income is the state pension with absolutely nothing else on top, you are still just under that line. And the government has said that pensioners in that exact position will continue to be protected from a tax bill going forward. But here is the risk. If you have anything else at all on top of the state pension, even a small workplace pension, some savings, interest, or part-time earnings. That £22 gap disappears immediately, and you owe tax on the difference. Because the state pension itself is paid in full with no tax taken out at the source, HMRC has to collect that tax through a different route. If you have another pension being paid through your employer or pension provider, it usually gets collected automatically through your tax code, the same way tax has always come out of a payslip. But if your only other income is something like savings interest, with no other pension to adjust the tax code against, HMRC may instead send you a letter after the tax year ends called a simple assessment telling you what you owe. If one of these letters lands on your doormat, the important thing is not to ignore it. You have 60 days from the date on the letter to contact HMRC if you believe the figure is wrong. And the deadline to actually pay what is owed is the 31st of January the following year. Missing that deadline can mean additional charges on top of the tax itself, which is an entirely avoidable cost if you simply open the letter and deal with it within the window you are given. It is also worth saying clearly that receiving one of these letters does not automatically mean a mistake has been made. It usually just means your total income for the year ended up slightly above the threshold, often for the first time, simply because the state pension itself has risen while the personal allowance has stayed fixed for several years running. Understanding that distinction matters, because treating every letter as an error rather than checking the actual figures wastes the 60-day window you have to raise a genuine query if one exists. There is one more number coming up, and this one has an actual deadline attached to it, not just a number worth knowing. Number 3. The current threshold for pension credit is £238 a week for a single pensioner, or £363 and 25 pence a week for a couple. Those numbers moved up this April, which means if you checked even a year ago and were told you did not qualify, it is genuinely worth checking again, because the line has shifted and your own income has not necessarily moved with it. Pension credit matters for more than just the weekly top-up itself. Being on pension credit also affects the timing of your winter fuel payment. If you are entitled to pension credit but have not yet claimed it, getting that application in before the September qualifying week is what determines whether you are covered automatically, or whether you have to chase the payments separately afterward, which is a far less straightforward process. Pension credit claims can be backdated by up to 3 months, which means applying now rather than later can also recover money you were already entitled to earlier in the year. The only way to know whether you qualify is to actually run your own numbers through the official pension credit calculator on the official gov.uk website, because the calculation accounts for savings, housing costs, and other circumstances in ways that a simple headline number cannot fully capture. It is also worth knowing that even a small pension credit award, just a few pounds a week, can open the door to other support entirely separate from the cash payment itself, including help with NHS costs and council tax. Which is why checking is worth the few minutes even if you expect the answer to be a small amount rather than a large one. So here is the one thing worth taking away above everything else. There is no single correct number that applies to every pensioner. And that is not a sign that something has gone wrong with your payment. It is a sign that the system has two different pension structures running side by side, with additional state pension layered on top for some people and not others. What does matter, and what is worth checking this month rather than later, is whether your total income, including anything beyond the state pension itself, has crept over that personal allowance gap, and whether your income sits below the pension credit threshold that moved this April. Quickly in order. Number 1, check your actual state pension amount against the system that actually applies to you. Not just the maximum figure quoted online, because additional state pension can explain a difference that looks wrong but is not. Number 2, if you have any income on top of the state pension at all. Check whether you have crossed the personal allowance gap. And do not ignore a simple assessment letter if one arrives, since you have 60 days to query it. Number 3, check the pension credit calculator on the official gov.uk website, even if you were told no before, because the threshold moved this April and applying before September protects your winter fuel payment timing as well. 3 things to actually do this week. 1, log into your personal tax account on the official gov.uk website and check your state pension forecast and national insurance record line by line. 2, add up everything you receive beyond the state pension itself, and check that total against the personal allowance. 3. Run your numbers through the pension credit calculator on the official gov.uk website, even if you assume you will not qualify. If you want a second opinion on your specific situation, a licensed advisor can look at the full picture with you. If you know someone on the state pension who has been confused by why their number looks different from someone else's, send them this one. It might save them from worrying about something that was never actually wrong, while pointing them toward the one thing that genuinely is worth checking. None of these 3 things require a complicated decision today. Just a few minutes spent confirming where you actually stand. Rather than assuming the headline figures everyone quotes online apply to you specifically. Subscribe so you see the next update the moment one of these thresholds changes again. I will see you in the next one.